So right, you have finally reached it. You worked all your life and now you're retired. You can golf, you can travel, you can eat to the restaurant, you can take your grandchildren to the park. You have all the time in the world. There's only one problem here, your portfolio. The stock market goes up, goes down, goes sideways. There's a lot of volatility going on in 23. How can you invest in this crazy market? Are you sitting on the bench looking at the game, or are you participating in it following your retirement plan? Dividend investors, bonjour. My name is Mike Yehu. I'm the founder of Dividend Stocks Rocks, and I'm also a passionate investor. I have this YouTube channel to help you invest with more conviction so you can enjoy your retirement. So today we're talking about how you can invest in this craziness. As you can see on the volatility index, we have been served for quite a ride over the past 3 years. It started with COVID, obviously, and then we got like a grand depression, a grand bull market. 21 was crazy with meme stocks and all of those things. And then 22 kind of hit like the reality check. Interest rates started rising. The inflation didn't go anywhere. The war is still going on. And a lot of sectors went down. It was a bad year for your portfolio. So now you wake up in 23, we're almost 6 months in, and then some days it goes up, some days it goes bad. It started on the right foot on January and February, and then we're starting to have like those bank panic attack for regional banks in the US, and you may still wonder how you can invest in this crazy market. Well, the first thing is to understand is there's a big difference between volatility and the real risk. So let's go back in time. So I'm bringing you back here in 2008, and I want to show you what happened to Canadian banks. Why? Because it's very important. You go back in 2008, around May and June, everything was going well. The market was slowing down a little bit, but there was no problem. And then July happens, and Lehman Brothers goes bankrupt, and then everybody realized that they were selling products like mortgage-backed securities and commercial papers that nobody knew what was inside. And then you open the box and you realize, oh my God, those were like subprime mortgages where people cannot afford to pay their house, and now they're giving back the keys. So what's going to happen with the mortgage? Well, the mortgage is not going to get paid, and then a lot of investors and a lot of banks in the US, in Europe, and across the world went into some big problems. What happened for Canadian banks? Same thing, a lot of volatility, a lot of panic. Investors were just looking at that as like, hey, I don't believe you, CEO, telling me that there's no problem with your bank. You know why they don't believe you? Well, because the past 3 CEOs for other banks in the US said exactly the same thing. Don't worry about anything. We're having it under control. We have a strong balance sheet. And then 2 weeks later, they're just like, yeah, we're going to cut our dividend. We're going to lay off people, and we're not going to sure if we're going to make the end of the month. So for the same reason, panic happened in Canada. Stock price dropped by like 40 to 50% for all banks. But that was just volatility. In reality, there were no risks because Canadian banks are not built the same way as regional banks in the US. And for all of those reasons, if you knew those banks, you would realize, oh, this is a volatility problem, not a risk problem. Because the risk is real sometimes, and then you can lose money, but then you need to know what is inside your portfolio to make the difference between market volatility and the risk. The problem arises when you retire and you have a bad timing withdrawing money from your portfolio. So Morningstar did a study that is quite interesting on that topic. They established 3 scenarios. Quite easy, right? You retire with $500,000, you want to withdraw $21,000 plus inflation, and then what they did is that they just like averaged the same returns from year 2 to 29, so 5.4%. But they change the first year and the 30th year. So on year 1 for scenario A, you're down 15%. Pretty much what happened in 2022, almost there. Scenario B, you're at 540 all the time. And then scenario C, you're up 27%. So imagine that you start investing in 2021 or in 2019, and then you're up, boo, and you retire and you feel like a genius because that was the right time. So if you withdraw the same amount of money every year, and that's pretty much the goal, right? When you retire, you just want to create that constant flow of income that will support your budget at retirement so you can enjoy it without any stress? Well, depending if on your year of your retirement you started on the wrong foot or on the right foot, the value 30 years later goes from 100K to 800K. That's kind of crazy, right? For those who are more visual, Morningstar thought of you just to show you how the starting point at $500,000 and then boom, it drops to almost running out of money after 30 years, where if you have been very stable, you're all good, you protect your portfolio and then you just withdraw some like dividend or interest. Then if you started on the right year, then you're all golden. You're going to leave a lot of money to your children and grandchildren and everybody's going to be happy, right? So the key here is you want to be as close as possible to scenario B or scenario C and as far away from possible from scenario A. But there's one thing, you don't control the market. You have no clue what's going on. And this is probably why you're sitting in cash right now, because you're thinking, well, Mike just said it. I cannot invest in a year where the market is dropping, so I'm going to wait until it gets better. But the problem is you don't know when it gets better. So you're better off staying invested and having actually some safety nets in place to make sure that you are able to go forward. How can you do that? Well, the first thing is to focus on quality. So how can you focus on quality? Well, you want to buy stocks that will pay a decent dividend and their stock price will fluctuate when the market goes down. The business remains strong and they're going to keep increasing their dividend. One way that I've solved this for my own portfolio is to focus on companies that have a very strong dividend triangle. So you can see here, those are stats that are being taken from our website, Dividend Stocks Rock. For all of our companies, we look at the past 10 years. I prefer 5 to be honest, but then now you can see what happened over the past 10 years in terms of revenue, earnings per share, and dividend. Why looking at those 3 metrics versus others? Because there are you can look at debt, you can look at payout ratios, you can look at cash flows. There are bunch of ratios for valuation like PE ratio, average yield, etc. But why I decided to start with this? Well, I want a business that is able to maintain revenue and increase it as often as possible. So recession resistant, having a strong business model while people want their products or their service. They have growth vectors. So either they are a key player in their market, they grow by acquisition, they have strong R&D investment that keeps their technology edge or their project edge against competitor, they have strong barrier to entry. All of those factors will reflect a growth in revenue no matter what is happening in the market. As you can see on this graph, you can see that between 2016 and 2017, there was definitely an acquisition because boom, the stock went up, the revenue went up quite fast. And for the rest of the years, it's pretty much going up as clockwork. When you look at the EPS, the earnings per share, it's going to be a little bit more shaky. Sometimes going to go up, sometimes going to go down. Keep in mind that earnings per share are actually affected by accounting principles. So sometimes you're going to have write-off on goodwill, impairment charge, you're going to have amortization, and all of that doesn't affect the cash flow. So it doesn't affect the company's ability to pay its dividend. But over 5 years, over 10 years, what you want to see is some kind of a trend that goes up, something that is quite steady, and this is what we see here. So from time to time there's a drop. This is where you can dig a little bit further, see what's going on, why the company is making less profit. But overall, what you want once you have found a company that is able to grow their sales year after year, well, you want a company that is also making good profit. To be able to make good profit, you need to have good margin, you need to have good product, pricing power, and again, growth vectors. So now you found a business that grows their sales, grows their profit. Well, what comes next? Obviously, more dividend in your pocket. As a retiree, this is what you're looking for. You want to protect your income from inflation, and you also want to make sure that this business that you found that is offering you a generous yield do not fail you as a shareholder and cut their dividend in the middle of a golf game, because that would suck, right? So you want to have a company with a strong dividend triangle that is going to continue to increase its dividend year after year. As you can see right below, we have the 5-year annualized growth rate for this business. We're talking about double digit everywhere. That's pretty much like the perfect case. If you're wondering which stock is this, well, this is Broadcom, ticker AVGO, and I actually talked about it last week, so you can check out the link description below, or give me a thumbs up, subscribe to my channel. You're going to find that video on 4 undervalued stocks, and Broadcom is part of them. Before I move to my next trick to help you manage your portfolio in 23 for a retiree, I want to invite you to watch a full 1-hour webinar replay right there at dividendstocksrock.com/replay. I did a webinar last week. We had like more than 500 people live. That was crazy. I had like more than 1,000 registrations. So thank you there for registering, watching the replay and everything. The webinar was about how to handle volatility in the accumulation phase. So roughly in your 40s, how to size opportunities, how to get more confidence, and to make sure that you're not sitting on the sideline while the market is going up, and also, and most importantly, how to handle volatility when you are retired. So we're sharing more tricks, more freebies, and a strategy to protect your retirement income year after year and make sure that you never have to sell during a down period. So you save a lot of capital and you avoid scenario A that we have seen before in this video. So again, link is right there below me. So dividendstocksrock.com/webinar/replay. Free replay, nothing to do. You click on the link and then you start to watch the video. So take good notes. We had like a bunch of questions after that because I always do a live Q&A. So you're gonna love those Q&As as well. And if you look at the rest of the page, you'll be able to download all the freebies. Now, last trick before I let you go, especially for retirees, classify your stocks, your holdings into 3 categories: core holdings, educated guesses, and falling knives. What is the purpose behind that? Well, the purpose is to identify the degree of risk you have in your portfolio. Because when the market goes down, the volatility is going to take over, and yes, your portfolio value is going to go down. But if you have very strong businesses that would qualify as a core holding, you don't have to worry about anything. The core holding should be like the vast majority of your portfolio, especially at retirement. And those are the companies, like Warren Buffett said, that you buy, the stock market could close for 10 years and you're still sleeping well at night because you know that 10 years from now, the business is still going to be around, still going to pay dividend, and it's going to be a very good value. So those core holdings will tick all the boxes for your investment strategy in terms of metrics, in terms of qualitative analysis, everything. So obviously risk is still part of the game. No businesses are perfect, but those are very, very strong business model and they will fit perfectly within your strategy. The second categories are educated guesses. Those are a lot more interesting for those in the accumulation phase because they still have the ability to generate money. They still have the ability to seize those opportunities, and if they fail, not the end of the world. So an educated guess is a stock that is almost perfect. So it ticks most of the boxes, strong business model, but there's always one big problem. It could be a high level of debt. It could be a slowdown in the dividend growth. It could be like a bad timing, like strong headwinds that are happening right now. So those companies are usually down by maybe 10-20% on the market. So you might feel that you're seizing the opportunity, but there's still risk and reward balance to reach here. As a retiree, you want to avoid most of those. And then it's a perception. So some people will say Enbridge is a core holding. I see it as an educated guess. Both could be right. I'm not going to argue with you. It is really about your perception of your portfolio, and then you'll feel a lot more comfortable with it. What's easier to identify? A falling knife. A falling knife is a stock that drops like by 30, 40, 50%, while the rest of the market is not dropping by that much. So definitely a specific market event, a bad earnings, very bad news that will put a lot of pressure on a stock price. Sometimes it is completely justified that the stock price crumble. We may think about like US regional banks that had I had a pretty hard time dealing with higher interest rates. Some of them, they cannot just make it. Their balance sheet are completely busted, and this is why the stock price goes down. As a retiree, you don't need that. I mean, they're exciting, or they're high risk, high rewards. It is like the narrative could be super sexy, but you're not there. I mean, you want to enjoy your life. You want to relax and be stress-free. You have worked very hard for your money to save and to get there. So why would you bother with those exciting but deadly falling knives? So I would completely ignore them, and if you're in the accumulation phase, well, could be like 5% of your portfolio, because if you're making the right move, you're gonna make a lot of money, and that makes a perfect story for your Christmas party. But if you're wrong, well, it's gonna end up like a golfing story or a fishing story. Nobody's gonna hear about that one, right? So, all right, I hope that you have enjoyed this video. If you want the full webinar on how to handle volatility in 2023, just click on dividendstocksrock.com/replay. This is like a 1-hour presentation with a bunch of freebies. So I invite you, no risk, nothing, not even an email. Just click on it and you're going to be able to watch the video. Also, don't forget to give me a thumbs up, subscribe to the channel. Every Thursday morning, I publish a new video. And next week, we're actually going to talk about Enbridge and TC Energy. So until then, stay tuned and stay invested.